Investors flee Sydney units. Let's have a look. Hello everyone, Florian.Heise here, and welcome to another episode of HeiseSays. I've got my stein of coffee because what we're starting to see now is investors fleeing Sydney. Now, the latest SQM research has come out with their weekly asking property prices, and we'll have a look at that in a moment. But you'll recall, over the last few months we've been discussing, well, property. And often there would be articles in the news again and again of a young couple paying significantly above reserve, getting into a property. You know, oh, we paid 200 above reserve. Oh, we paid 100,000 above reserve, but we got into this apartment. We got into this building. We needed to get into it. It's our first step in the property ladder. Property always goes up. Now, I don't know about you, but those articles tended to terrify me. They really did. I felt quite sorry for the young people there. Probably because, well, hopefully I'm still close enough to them to relate to them. But they'd taken on so much debt. And then when you look at the price of some of these things they were buying, well, two problems. If you look at the price, you know, a one-bedroom unit in Sydney costing close to $1 million, which is insane. And I know how these things are built. Plus, I've spent months as well looking at just all of the construction defects and problems in Sydney. So that all of these things combined together probably is what encourages me to be concerned and worried. Now, we've got many people, many property spruikers who are thinking, oh, property will always go up. And they can list reason after reason why property is stable here. We had the RBA recently model a drop of 40% in housing value. Now, this wasn't to check to make sure we'll be okay. It wasn't to check to see the economy would be robust. It was to check to make sure that the banks wouldn't collapse. Now, they said it was unlikely, but still plausible. Other people have been predicting or arguing that our property is in a bubble for quite some time. And, you know, the canary in the coal mine is the investor. The genius, as we've seen other examples, where people go credit only or pay interest only on a property. They'll negative gear it, and they'll buy another one with the equity they've got, and they'll buy another one, and they'll buy another one. This is the magic sauce or the secret trick that they'll all tell you. And sure, there are other ways that people can do to tweak it, to get tax advantages, but fundamentally that's it. They're just using equity in one to invest in another and another and another. What happens when the dominoes start falling? And is what we're seeing here, because some of these falls are up to 15% in property. Investors are giving big discounts to get out. Is this the smart money leaving? Because remember, investors are not as emotionally attached as you or I are to our primary residence, our home. It's an investment. It takes time to sell, and perhaps they're using this as an opportunity to get out of the market. Remember, we still have JobKeeper propping up businesses. There's a lot of zombie businesses out there. Yesterday in an article we read that approximately business for insolvency practitioners is down 70%. So just think about that, a number of businesses that should be going down. So we've got JobKeeper there that we can put to one side as propping up the market. Think of it as a dodgy slab that's about to crumble, or a dodgy slab that has concrete cancer and you need to repair it, so you put props underneath it. So one of the props that we got there is JobKeeper. It's holding it up, starting to struggle, but it's holding it up. The next is the increased economic activity resulting from the bonus payments to job seeker. You know, that's the argument of whether the dole needs to be increased or not. That's something to put to a side. But at the moment, it's been increased, and you've got more economic activity resulting in that. That is also starting to taper off. That's going to have an impact because every dollar someone spends is another person's wages, is another person's mortgage payment. Maybe people are reading the tea leaves and predicting, okay, JobKeeper's about to disappear. Job seeker's going to get reduced. I'm having trouble getting a tenant for my property. Vacancy rates in Melbourne, listing rates in Melbourne are up over 100% in some suburbs. You've got the amount of rent that they're asking there is down 17% in some. There's about 40,000, and we'll look here at the picture, 40,000 properties in Sydney, apartment surplus. Same thing here in Brisbane, we have an apartment surplus. So it's quite a concerning situation. So the question I pose to you, viewer, is this the beginning? Because we've got two pillars here. We've got two ag props holding up the slab. You've got JobKeeper, you've got JobSeeker, and now we also have trading while insolvent. So as a director of a business, if you trade while insolvent, if you knowingly conduct business while insolvent under the Companies Act, you can be held personally liable. I know because I've tried to ghost someone because they refused to pay an invoice that they were legally required to pay, so technically they were trading while insolvent. Bastards cheated me out of 15 grand. Now that's been taken away. I won a QCAT case against him and wanted to get like a bailiff to hunt them down, like in the movies. You can't do that anymore if it happens again. That scares me for the construction sector. It really does. Because often you'll get people taking money from one job, then using it to prop up another project. And I've got my camera is playing up to me today. So those are the three issues, the three main things propping up this sector. So let's have a look at this data from SQM, because I suspect this is the beginning of the smart money exiting apartments. And I had a look around and I'll show you a few websites where you can have a bit of an adventure to see previous or prior listings for certain property, because it's interesting to see, because it's harder to find. Now this is SQM research, and we can see here this is the weekly asking property price. We can see here it goes all the way back to 2009. So this is all units. So 2009, all units in Sydney was 588, and then it got up to, I don't know what the peak is, probably 1.2 for all units. 1.2. But just recently, in April this year, it was still at 1.2. Now, the asking price for all units, down from April, it's going down. 1,060,000. So nearly a 200 grand cut. 180 grand cut, everyone. 15 to 20% hit. 2 apartments just since April for the asking price. This is the smart money. I put the theory to you. I put the argument to you. This is a sign of investors getting out of this sector, doing what they can to exit now. That's the first card. We have a look here. Here's what is it? The blue one is 3-bedroom houses. They were down, and they were down. They were close to 2-bed units, nearly 1.4, and they've jumped back up to 2 million. This is all in Sydney in the 2000 postcode. You've got 2-bed units down here. 2-bed units here went down, and they've jumped a little up. They've jumped up, and all houses is from, pretty flat at the moment, but it has gone down from April. So it has gone down from April. So let's jump over here to this other data. This is weekly rents. Weekly rents. We've seen repeatedly how rents are going down. People are negotiating better deals. We can see here rents are going down. 2-bedroom units for all units. We can see here all houses rents are going down. And remember, this is right back to 2010. So you can draw a line across here. So we're at 461. How far back is that? How far back is that? So rents are now round about October 2013 for all units. So there you have it. And here, all houses, let's look back, it's 629. Let's go back in time. So about 2013. We've had a little bit of inflation since then, haven't we? I doubt that's taken into account in this, or maybe it is. But there you go. Then we have this other one. This is the weekly asking property prices. So this is weekly. This is WikiLeaks asking property. What's the difference between... This is the city of Sydney. This is postcode 2000. So you can see here, again, they're tracking down, 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 down. Now, there's a website I want to draw your attention to. One I think everyone should be familiar with. When you're looking at property, when you're looking at investing, when you're looking at buying a home, being armed with as much information as you can is invaluable. Don't trust the agents. Don't trust the real estate agents. They're not your friend. They're business people. They need to make a deal. Maybe if you buy a buyer's agent, it's a bit different. But still, you need to be armed with as much info as you can. And this is a very interesting website. This is all listings. And you can see here just all different what data they have. Jelly Street, different advertised prices. Now, these are units. So the problem is you need to make sure you're not looking at the whole building, because I'm assuming it has multiple units, because I doubt this one, if it was really 1.5 million, must be a nicer unit in the building. So let's go. So you can see here all different apartments or houses. Unit, that's what it was listed for in August. Here you've got another one. And it just shows you what other listings there were for these properties. So this is useful to get an understanding of what properties are. So one, Hoskins Place, 690 to 715, and you can see here how far it goes back. But it depends on the particular unit. But then again, it generally be roughly the same. So if we jump here, you can see how many are currently for sale in Sydney 2000. We have a look here as well. So, what do you think, everyone? Do you think this is the beginning of an exodus of the smart money or the investors from Sydney? Are they getting out of the units? We've got to remember, I'll bring up one of my favorite charts here, just showing how ununiform unit price growth is. If we're seeing some apartments already in Sydney 2000 down 15% since April, shouldn't that be making headlines? Shouldn't that be in all the news? Shouldn't that be concerning? We'll have to see. I suspect it is the smart money leaving. I think it's the beginning of property or the investors getting out. And I think we will really start to see this ramp up. Well, I think it's fear. I think it's fear of not being able to get out, of being stuck with property that you may not be able to rent or at a much lower level when all the support mechanisms are removed. Oh, and I forgot one. Of course, there's a fourth support mechanism that I completely forgot. The mortgage holidays. Maybe these are some of the investors that are getting the tap on the shoulder to get out, because that ends in March. So that's when we'll really start to see the impact of this. Now, I asked all of you to answer some questions in a survey that I did on my channel. And let's have a look to see what the responses were to get a bit of an understanding. And the question I asked was, when do you think people will start to feel the recession? Because the argument I made was that, well, we're not really feeling the recession yet. A lot of people are not. And I had 863 votes. Thank you all very much for those of you that voted. And you can still vote. It's still open. So never or V-shaped recovery, 8%. 8%. And although one person admitted in the comments they did that just to troll, but still 8%. So end of September 2020. So we're in September now, the end of this month. Some people are expecting to hit it. They're expecting the reduction in JobKeeper and JobSeeker and the trading while insolvent provisions being removed. They're expecting that to hit hard. And it might, because that trading while insolvent provisions, that's probably keeping some business, it's keeping some businesses going because those directors don't want to be personally liable for their business going under. Maybe they're just keeping it running to keep people in JobKeeper to help out their staff when they know it's going to collapse. And then once these provisions are removed, they might jump ship because they don't want to lose their own home. December 2020, nearly 40% of you have voted for that. April 2021, 24%. That's after the bank. December is when the job seeker bonus runs out. April is when everything's going to run out and the mortgage holidays will run out. And July, I put that there, which 11% of you voted for, was because it was the financial year crossover, next financial year. And that's when people know they can't keep going and they know the tax office is going to get them. So there we have it, everyone. What do you think? Do you think this is a hit to the apartment sector? Do you think people are starting to leave and sell out? Or is it just a little blip? Something we shouldn't worry about? Are you going to run in and get a bargain? Get a bargain? Because there was an article a viewer sent me where they're portraying it as a young couple getting a bargain. If it's a bargain that drops another 20 to 30%, is that really a bargain? As always, thank you for watching. Please like, share, and subscribe to the channel. If you're a fan and want to support the content I create here, there are a few ways you can. You can join the channel on YouTube or Patreon. You can support us using our affiliate links at Amazon, eBay, Independent Reserve, or Kucoin. You can buy merch from HeiseSays, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, everyone. Have a great day, and I will see you all in the next episode.